Okay, I see we have a number of people tonight joining this session. So I'm going to go ahead and start it a little early and open it up to see if you have any questions before I actually get into what chapter 6 is going to look like. If you do, take yourself off mute and let me know what your question is. All right. Well, I don't see anybody taking themselves off mute to ask any questions. So I'm going to go over a couple of housekeeping topics, and then we'll go ahead and dive into the material. One of the things I am realizing as I'm talking to students who need help understanding the different concepts we've learned so far is I'm not seeing a lot of attention being paid to reading the chapter. And I know that that is typical for a number of classes where they think that they can come in and listen to a lecture and be successful still in passing the quizzes and tests. That's not the case with accounting, because first of all, y'all are on internet only, and these live sessions are just designed to really be here to answer your questions. Now, I actually go through the PowerPoint presentation I do in my face-to-face class because I've done a number of these meetings where no one's asked a question. I've had as many as 10, 11 people join, and nobody wants to know what the chapters are about. And if you notice, I point out to you in these videos that I give you references to go back to the textbook and go back and be able to refer to as you're doing the homework and as you're doing the quizzes. And could be as you're doing the test. I mean, look, it's all open book until you get to the final. So take advantage of every, resource that's out there in order to be able to try to be successful. It's discouraging when, I'll get questions that are well explained in the chapter. And after talking to the person, I end up having to go back and guide them to the chapter. And that's been happening more and more. So again, if you get stuck, you got the resource right there. In fact, everything we're going through in this PowerPoint, everything in this PowerPoint is in your chapter. So that's where the PowerPoint's coming from for the most part. Okay, we're going to get into chapter 6 tonight, and we're going to talk about cash mainly, accounts receivable, what we call the most liquid of assets, the ones that can be easily converted into money. Also, these happen to be the ones that are most easily stolen. So we're going to talk a little bit about how to control the assets and protect the assets so the company doesn't realize losses. You can see by this first slide, we're talking about what are internal controls. All right. Well, they're used to monitor and control business activities. First and foremost, to protect assets. But secondly, and we talked about this is the purpose of GAAP. It's to ensure reliable accounting, to make sure that if you're comparing companies, they're both doing their books exactly the same way. Okay. Company policies come into play. Company policies are in place in order, again, to protect the assets. And then finally, to promote more efficient operations. I'm going to leave the Sarbanes-Oxley portion for you to read in your chapters and explain what that is, because I want to kind of get to the meat of what we're talking about. All right. So the eagle, because I don't believe it might show up as a question or two in your quiz, but I don't think it's in homework. So here's what internal control principles are common to all companies. First, you establish responsibilities. You break down jobs so that everybody knows exactly what they're responsible for. You're going to maintain adequate records. Some people think too many records, but too many records is better than not enough records. As an example, there was, in talking about establishing responsibility and maintaining accurate records, I'm going to jump down to dividing responsibility for transactions. There is a case in the Belk warehouse, I believe it was in Union, where they found an employee was making it look like merchandise was bought from the warehouse, and she saw to it was shipped out to friends and family. And it took until she had stolen $65,000 worth of merchandise before they caught her. They should have caught her a lot sooner than that. And the reason why I say that is if they had these 7 or 8 principles, then she would have never got to $65,000. She might have got to 20, but she never would have got to $65,000. So that's why these principles are important. And even if it's not a heavily tested item in this chapter or this unit, if you're in business and you plan on being in management, you need to understand the importance of these, okay? I'll give you another example, real world. When I was a director of operations, one of my jobs every time when I went into a store, besides looking at the operation as a whole, I would inspect the cash record keeping in the office. And one of the things I used to do, one of these established principles was I would pull out the cashier reports. I would match up the deposit slips of the cashier reports, but I wasn't just looking to make sure that the dollars matched. I was looking at when the money went to the bank. And a longtime manager who worked with me and for me, this manager went and was rolling deposits. So he had ran up a gambling debt at one of these video poker places back. This is in the day when video poker was big here in the state. And he rolled over, he had to go pay off a $2,500 debt to the company where he had messed up. And so he would exactly roll over a deposit every 24 hours instead of putting it in every 12 hours like he was responsible for. Had I not gone in and did the inspection that I regularly do when I go in and visit the restaurants I was responsible for, I would never caught him. And so, yeah, this is what we're talking about here. And we're looking at these principles is to have things in place. My district managers used to audit the inventories taken. They would take a different inventory every week in a different store. They would also have to, and we're going to talk about this later, is actually do a petty cash audit. And so that there would be a second set of eyes on it instead of the manager doing the petty cash audit themselves. Because when you leave it up to people to do this stuff that they're responsible for, there's always a temptation to be deceitful and to steal. Not saying they do it all the time. I'm saying there's always the opportunity, and internal controls take away opportunity. Okay. Again, this information is in your book, so I'm going to get to the meat of what we're talking about here in this chapter, which is the transactions that you're going to be tested on. So I do want to discuss this. So separate record keeping from custody assets. So a person who controls or has access to assets must not have access to that asset's accounting records. Where we run into this too is in department stores. Department stores have a very sophisticated way of checking out employees who are responsible for cash. And the cash, is separated from the records early on so that the person making the deposit is not the one that's recording what the deposit is in the books. So another example of that there. Plus, I gave you the Belk employee thing. All right. I'm going to pass by this. Oh, blockchain is introduced this year. Okay. The only thing I want to say about blockchain is it allegedly cannot be changed easily. I'm beginning to have my doubts because I hear every day that I see Bitcoin exchanges get hacked. They may not be the same thing, but still, I think it's a matter of time before someone finds a vulnerability in a blockchain. And we're talking about the limitations of internal control. First, we have human error, which is a cashier making the wrong amount of change, maybe filling out a check that for paying for something incorrectly. A lot of times, there are professional thieves out there that will gang up on a cashier and get him so confused that it forces them to make mistakes to where the errors are always in favor of the person trying to defraud them. And then you have out and out fraud. So, and I think I mentioned in here on a prior video, locks were made for honest people, that if you have a thief working for you, they are going to beat any system you have in place. So that means you've got to make your systems bulletproof. But if you just have systems in place, you'll also keep people away from temptation. And we just talked about this in the first chapter in the fraud triangle. So what are cash control systems? All right. Well, the first thing you want to do is you keep the cash separate from the record keeping. I just mentioned that earlier. So like when a cashier takes her drawer back to the cashier department to check out at the end of the night, that person verifying the cash is then going to make a record of what should be there, and then going to put the cash going to a separate person for going to the bank. Another best practice is get the money in the bank right away. Now, we never used to make night deposits because of the high probability of crime, unless we get a police escort for our stores. But that money would go to the bank first thing in the morning by the day shift manager. Okay. And then whenever you make payments, don't pay cash, pay it by check or direct debit. And there's very few places now that do business in cash, especially businesses. Businesses may take in a lot of cash, but you want to make payments to the people you're buying stuff from by using a check or an electronic funds transfer. So there's a record. So you have a record of exactly where the money went, who it went to, that sort of thing. And again, cash is easy to steal. There's hardly any way to trace it once it's gone. Now we have something called cash equivalents, and liquidity. Liquidity is how easy is it for something to be converted into cash and used as cash. You can see the definition of cash as currency, coins, and deposits and bank accounts. All right, that's what we consider to be cash. It also can include customer checks, cashier checks, certified checks, and money orders. I know a lot of you don't know what these things are because you've never done them. You're used to downloading an app from your bank and doing everything on your debit card or by electronic means. But customer checks are still taken by some businesses, although it's becoming more rare because everybody has bank cards. Cashier checks are very common. If you buy something that's high value, such as property or automobiles or something like that, you're not going to carry the cash to the place where you're doing the transaction. You're going to take a cashier's check, which is a check issued by a bank that guarantees the money is there and to be paid. Cashier checks are negotiable. Now, your personal checks are negotiable, but only up to a point. When you present somebody with a cashier check, they can turn around and trade it for something for something like use it to go buy something or whatever. And that person that's accepting the check in exchange for that knows that the money is there and it's good. Certified checks very similar to cashier check, and money orders are, if you don't know, people used to travel with money orders. So they would go in and buy, like in the American Express money orders. They usually came in denominations of 20s and 50s. And you could take those and spend them around the world like cash, and people would take them. Short-term, highly liquid investments are readily convertible to cash. And we're going to see some examples of these. For instance, accounts receivable. Why do we put accounts receivable as an asset? Well, we put them as an asset because those people owe you the money. These are your customers that owe you money. And so you can go down to the bank and you can sell those accounts to the bank. Now, you're going to get about 80 cents on the dollar, but if you're strapped for cash, that's a good way to get the money in your pocket. Okay. So the goals of cash management are plan cash receipts to meet cash payments when due, and keep a minimum of cash necessary to operate. And these are two conflicting things. You got to have the money when you need to pay the bills. All right. Now, by what we mean by the minimal level of cash necessary to operate is you want to keep your money invested. When we're again, remember what cash is? It's bank deposits. You don't want to be sitting there with $100,000 cash in the bank, not drawing any interest. So when I say that you want to keep a minimum level of cash, you might keep the balance of most of that money invested in something that will produce income like CDs or stocks or something of that nature. But you got to have the cash ready because, a lot of businesses are seasonal. They have a swing up and down as far as how they operate in having to meet cash payments. So if you have a restaurant at the beach, all of a sudden your need for cash goes up greatly in April and May as tourists start coming down, say to Myrtle Beach. You're going to be buying more product. You're going to be hiring more help. So then you're going to have to make sure you have the cash available to meet those payments. The effective cash management strategies are encourage collection of receivables, delay payment of liabilities, keep only necessary assets. In other words, keep the money in the bank, not on the shelf. Plan expenditures and invest your excess cash, like I told earlier. Now, I want to focus on one thing here, and that's collection of receivables. There's a show on called The Profit, which I'm having a hard time finding any students that watch it, which worries me because these students are business students, and I would think they want to watch everything about business they could. It's on CNBC, and one of the earlier shows, The Profit, by the way, is, oh goodness, I can't remember his name, but he owns Camping World. He's a billionaire, and his hobby is going around finding businesses that need help and trying to get them back on track. And the one business he did this with was a fish restaurant market wholesaler. They did everything, and they were really strapped for cash. They had a really good business going, but they were always strapped for cash, always running out of money. And the first thing he did is took a look at the receivables, look at what these people were owed. And they were owed $250,000. And he stood there and looked at the office manager and says, do you ever call these people and ask them where the money is? And she said no. And so for the next week, that's all she did, is called all these customers of those with all this money that was owed to them, and ended up collecting half of it by the end of the week. So that's why collection of receivables is important. All right. Another tactic is delaying payments of liabilities. And unfortunately, I know of one of the bigger box stores in our country that's considered successful, at least for a time being, was paying their bills in 90 days, which is to me unacceptable. You should be paying no longer than 30 days. And that's how some companies fund their business when things are tight, is they just stop paying their bills or they slow down paying their bills. So I'm not encouraging that as a strategy. You should pay your bills within at least 30 days. And plan expenditures. That's called budgeting. You'll learn about budgeting if you continue with accounting. And then keep only necessary assets. One of the things we used to do is we had standards in our restaurants on how much inventory could sit on the shelf. And if, you know, your inventory, we inventoried every Sunday, so we know how much money was in the store on the shelves. And if it didn't meet our objectives, myself or district manager would be in there having a serious discussion with the GM for that store. This is a graphic that I believe is still in your textbooks. It basically shows what I was alluding to earlier about how cash is divided up from the actual record keeping in, say, a department store. And they do this. You can see it looks like a lot of record keeping, right, for the cash. But without these controls, somebody can be tempted to, pocket the cash. I'll give you, even in our federal government, this is something that's looked at. And the example I want to give you is the IRS. The IRS will tell you when you make out a check to them, do not make it out to the IRS. Make it out to the Department of Treasury, because what happens is people will make that out to the IRS. Checks will be stolen by IRS employees, and they will fill in their names on that line because there's so much space open. True story. So, word to the wise, make your tax payments online or fill that line up with Department of Treasury on your check. Believe it or not, when I was working for the IRS, about 250 people each year went to jail for a number of reasons, and one of them is including cashing those checks, which makes you wonder, why would somebody do that? Because the taxpayer is going to complain to the IRS, all right, and they're going to provide a copy of the check that was cashed at the bank, because they're going to go to the bank and get a copy of it. And then lo and behold, when the investigation is done, they're going to be arresting the employee because the employee left a paper trail. So anyway, all right, the first thing we're going to deal with is cash over shorts. Cash over shorts always occur. If you have somebody with a perfect register, after the end of every shift, you need to be suspicious. You also need to have a discussion with the employee if their shortages are excessive, like not $5 in our example here, but 20 or 30. It's a balancing act, but anyway, so what happens when we have a shortage? So if a cash register shows 550, but the count of cash is 555, here's how you prepare the entries. You're going to debit the amount of cash that you actually received. Okay. So that's $555. That's what you counted in the cash register. Next, you're going to credit sales for what you actually did in sales, which is $550. Now, it just so happens you have a cash over short of $5. So if you have an overage, it is credited because it's just like sales. Okay, it gets added to your sales. You're going to get taxed on it. If it's a shortage, it's like an expense. And what do we do with expenses? Normal balance for an expense is a debit. Okay. So if it's over, it's a credit. If it's a shortage, it's a debit. Make a note of that. Okay. And here's our example of a shortage. Cash register shows 625, but the amount of cash is 621. We're going to debit the actual amount of cash we counted, which is 621. We're going to debit cash over short because we were short $4. And then we're going to credit sales for the amount of sales on that cash register, which was $625. Whenever you get receipts by mail, you should have a system where you have 2 people assigned to open them at least. And that should really go, and a perfect example is the church, where you have envelopes with money and checks in them. Now, there was a time when I was on the finance committee of my church, and the preacher found out I worked for the IRS. and they needed an audit done. So guess who he comes to? Comes to me. He also knew I was teaching accounting at Greenville Tech. And so myself and two other people who were also accountants that went to that church, we did an audit, and we found out that at the end of Sunday service, one person collected all of the envelopes, stuffed them in a bag, took it to the bank and deposited it. And then secretary went back next day to get the bag. So it was because they didn't have a safe in the church. So that's the safest thing they could do. She would bring it back to the church. She would open all the envelopes, count it, make out the deposit slip, and take it back to the bank. How many principles did we violate right there? Well, right off, there wasn't two people that even opened the envelopes. They just got thrown in the bag, and the secretary did it all. All right. So what you should do, here's what we went to. Two people on the finance committee had to be there after church every day, opening the envelopes, and we would record every check in a log. We would count the cash together. I would count it, another person would count it, or whoever two people had the duty that day. And then the deposit slip was made out, put in the deposit bag, and then the next day, the secretary would come and she would pick up the deposit slip and reconcile any differences there might have been. And the log then was used to record who had donated what, and so that the annual statement could go out. All right. Again, what are best practices? Well, pay everything by check. Pay as little by cash as possible. Now, in our restaurants, if we had to go, we ran out of ketchup on a Saturday night, we would send an employee to buy low. We give them a $20 bill, tell them bring back the receipt and change. And, you can't get around that sort of thing. In fact, just about every business that's out there has a petty cash fund. All right. And we're going to learn about a petty cash fund. But understand you don't want to do that if you can absolutely avoid it. So you want to pay by check or automatic bank debit. Okay. There's a voucher system that most companies use. Okay. And I'm trying to think of the best way to describe it. Really, I don't think we have an example in here, but it's actually you fill out a voucher and usually has to be signed by two members of management, or there has to be two members of management in the process so that the cash payments are validated. All right. A lot of companies require two signatures on every check before they go out. In fact, we implemented that policy at our church. Our church, one person was only required before the audit. After the audit was done, we got it in place so that the head of the finance committee and the secretary both had to sign checks for every bill that was paid. So he would stop by every Friday and do that. Now, the voucher system, I'm going to explain this to you as best I can. This is normally what's done with most companies. Smaller companies don't do this as much, but when you get to a certain point where you're doing $5 to $10 million in sales, usually you're going on this because you have too many people that can take advantage of the system. So if you look at the very first, I know this may be hard for you to read, but if you look at the very first envelope, it says purchase requisition. So let's say you're a manager working for Michelin and you're running low on tires. So you need to send a purchase requisition over to Michelin. But you're not going to do that. You're going to send the purchase requisition to the purchase department. They will then place the order with Michelin. Okay. And after they do, they're going to send a copy of the purchase order, as you can see, to the manager, to the receiving department, and the accounting department. So when those tires come in, the guys on the back dock are already going to have a copy of this purchase order, and they're going to match it up against the receiving report that they get. It's called a bill of lading that comes in with the tires from Michelin. In the middle of that process, when after Michelin ships the tires, they're going to mail an invoice to your accounting department. And your accounting department's going to then match up the purchase order with the receiving report from the loading dock. And if they're satisfied everything's in order, they're going to pay the bill. But they're not going to just pay the bill directly. They're going to send it to the cashier department. So after the invoice has been approved, they're not going to sit there and write the check. They're going to send it to a different department responsible for paying the bills. And then a check is sent out by the cashier department to the supplier, so the bill is paid. And a lot of times now it's all done electronically. So a lot of this paper that used to be there isn't really there anymore. It's all done electronically, and approvals and everything are done through email. If you ever watch The Office and wonder why they had so many employees selling, just paper, well, a lot of the paper they were selling was these type of purchase orders, invoices. This was a big business before computers came around. Not only were they selling ledgers for bookkeepers to do their general journal entries and ledgers, but also these pre-made forms, purchase orders, invoices, that sort of thing. It was a big business. All right, now we're going to get into petty cash. Petty cash, like I said, is normally in existence at every type of business. We used to have at Shoney's about $500 in petty cash, and that was enough that they could keep change to get through a weekend. And that's basically it. I mean, they didn't really have to buy that much at the store. If they spent money at the store, it's like $50, over a weekend. And as you can see, you're going to pay for shipping fees, minor repairs, and low-cost supplies. Example of shipping fees. When I was with Hungry Fisherman, I was running a store in Columbia. It's about 40 years ago. And we would run out of, say, shrimp. Now, you don't want to run out of shrimp at a Hungry Fisherman. So I would call Lake Wiley, and Lake Wiley would send me what I need if they had it to spare. They put it on a Greyhound bus that night. Usually they drop it off on their way home. And then next morning, I would be at the bus terminal picking it up. Because if you're shipping a 50-pound case of shrimp, it stays frozen. It doesn't thaw that quickly. And we'd have to pay cash. So those shipping fees would have to be paid for in cash, and we pay for it out of petty cash. Okay. Minor repairs. I would have electricians, plumbers, that kind of thing on call. And a lot of these guys didn't have regular companies. They were like part-time jobs, what we would call independent contractors, and they'd want to be paid cash. In return for that, they wouldn't kill us with overcharging us on invoices and stuff like a lot of these regular companies do. I might pay for a plumbing repair $200, but I pay one of these guys maybe $125 because we're paying them in cash. And low cost supplies. I gave you the buy low ketchup example. So when you establish a petty cash, let's say you're opening your store day one, and you have to establish a petty cash fund. You're going to debit petty cash $75, and you're going to credit cash $75. Why are we crediting cash? Well, we're having to take cash out of the cash account to set up the petty cash drawer. Again, petty cash is literally cash. You're going to have money sitting in one of those little lock boxes in your company safe, and you're going to be paying this small stuff out of it until you run out and have to do a petty cash reconciliation, which we're going to learn how to do. So petty cash is going to be carried on the books as an asset. That's important. You keep that in mind. All right. It's not going to be included with the cash account. It's going to be carried as a separate account in a account ledger. This is a petty cash reconciliation. So typically what myself or my district managers would do, we go in once a month, pull out the petty cash box, take top drawer out because that's where the money was. We count the money, see how much money's there, put that down on the report. Then we would list all the receipts that we had. Okay. And as you can see here, this particular example, we had 4 receipts. First one, we transported merchandise purchased. That's 1505. Where does that go, by the way? Well, if you've been keeping up, especially last week and the week before, when you're paying for transportation of merchandise you are buying, it gets added to inventory, merchandise inventory. If you're paying to send merchandise you sold, that becomes shipping expense, and that's a debit to shipping expense. Okay. Next, we have purchase of office supplies. That would be another item we would go out and pay cash for because we didn't use a lot of office supplies in restaurants. Here we have a receipt for $475. Customers package delivered. There's an example of where someone's buying from us, and that's going to be $5. And then finally, tile cleaning for $46.50. So we have a total of $71.30. Now, we set up the petty cash for $75. So we better have $3.70 sitting in that petty cash drawer in coin and bills. When we go to reconcile, then you can see what our debits are going to be. All right, this is the general journal entry, how it looks. Notice the date is the day we actually do the reconciliation, November 27th. And we're going to list all the debits, which are merchandise inventory, office supply expense, delivery expense, and merchandise and miscellaneous expense. And then we're going to credit cash $71.30. So what happens is that check will be cut by the home office and go back to the store once they get this report. And that should bring the balance back up to $75, which is how we set it up. Now, there are times when you want to change the amount of petty cash. You might be constantly running out of petty cash, and that's no good. So you'll ask the home office to increase you a certain amount. And here we increase it by $25 to $100. So we're going to debit petty cash $25, and we're going to credit cash $25. If we have too much money, let's say we want to take it from 75 down to 55, because again, remember, one of the principles is you want to keep the money in the bank. All right. Keep as little money on hand as possible. That just doesn't go for money. That goes for inventory too. So we're going to go ahead and debit cash, excuse me, because we're putting the money back into the cash account. And then we're going to credit petty cash $20. Now, what if you're over or short? All right. So first example, petty cashier fails to obtain a receipt or overpays an amount for something they bought. They're going to have an over short. All right. The shortage is a difference between is debited to cash over short, as I mentioned, and an overage is wait a minute. Shortage is debited to cash over short. Look at a shortage as an expense. Overage is credited to cash over short. Look at an overage as extra income. Okay. And that's how it's going to be listed. If you look down below, that is going to be the general journal entry we make. We're going to report that shortage or that overage on our petty cash report, and they will adjust the check that we get back from headquarters. All right, next is bank services. And I know very few of you will probably have much exposure to any of these things unless you do accounting for a business already. But basically, a bank is going to make sure they have on hand in their possession signature cards for you. You're going to have to deal with deposit tickets, checks, electronic funds transfers, and bank statements. When it comes to bank statements, you're going to have to reconcile them every month to verify what you have in the bank. So this is what a deposit ticket looks like. As you can see, the first space is for the amount of currency, then the amount of coin, This does not look like a deposit slip you're going to use for your personal account. Okay. Then you're going to list all the checks on the back of the deposit slip. Now, sometimes if it's a really extra long deposit slip, you'll put them on the front, but usually, and then they'll have a place on the back for overflow. But, generally speaking, you're going to list all the checks together, total them up, and then put that total under total checks, as you can see for 203.50. And then you're going to add your currency and your coin, and that's going to be your deposit. And that is something you need to hold on to. A check is normal. This is what a check looks like. There's two parts to it. The top part is the check itself. The bottom part is the remittance advice. In other words, it says what you're doing up top with the check. And typically, the person you send this to will tear this off and will keep it as evidence that they received the check. Okay. So as you can see, a couple of things that are important is you have the maker of the check, you have the payee, you have the bank that it's going to be drawn on. You have a memo section, which is very important to fill out. The date's important and the amount's important. And as you can see, you have a handwritten amount of $375. Then you have a cursive amount that's written out, $375. This is what a bank statement looks like. You're going to have withdrawals and you're going to have deposits. Okay. And you're going to match this up against your checkbook at the end of every month when you get it. Usually these come 3 or 4 days after the end of the month. You can see the statement date is October 31st. So this will have in the bank statement everything the bank knows about from October 1st to October 31st. But the bank doesn't know everything, and that's why you have to reconcile. For instance, what if you make a deposit on October 31st at 10 o'clock at night? You think anybody's there at the bank to record it? No, it's going to go on the next business day. You're also going to write checks between the 1st and 31st that aren't going to get cashed, sometimes for up to 2 months. So that's why you have a reconciliation. You don't know. Now, if you look at this bank statement, it's got a check printing charge for $23. You don't know that. I mean, you might have ordered checks, but the bank's going to take the money out when it suits them. So you have no clue that money's been paid until you get the bank statement. Then you have a non-sufficient fund check. You don't know about it until you get the bank statement. So the bank's going to deduct that from your account. You can see here you had a note collected by the bank for $485. Again, that's something you don't know about till you get the bank statement. And then finally, look down at the bottom. You've earned $8 in interest. You don't know about that until you get the bank statement. So you have to reconcile the bank statement for things that you don't know. Okay. You also have to reconcile for things you do know. You do know that you made a deposit at 8 o'clock at night on October 31st. Everything was closed. You know that, but the bank doesn't know that. So that's not going to be included on the bank statement, but you're going to have to include that in your reconciliation. Again, this is an area where you want to have your bookmarks in your textbook to be able to refer to this because this very easily can get you tripped up. So the bank adjustments are going to be, we're going to add the deposits in transit. That's that example I gave you of October 31st, 8 o'clock at night. Then you're going to subtract the outstanding checks. Those are the checks you wrote during the month that you know about, but they haven't been cashed yet. They didn't show up on your bank statement. And then you're going to add or subtract the correction of bank errors depending on how the errors fall. That's part one. Part two is your side, which is the book side. You have the bank side we talked about. Now we got the book side. You don't know about the interest, so you have to go back and add that in. It's going to be a journal entry. you're going to have to subtract the bank fees because you don't know what the bank fees are until you get the statement. So you'll have journal entries for that. You'll have journal entries for the checks that bounce. That's the NSF checks. They bounced. You didn't know about it. So now you have to go back and correct your books to show they bounced. And then you're going to have errors, and this is mainly transposition. You wrote a check for $79, but you wrote in the ledger 97, stuff like that. So you can see here that you have, again, you need to, this is in your chapter. It's one of the exhibits in there. You need to refer to this so that you know how to put together a bank reconciliation. This is exhibit 6.7, another good example of the bookmark. You can see we started off with the bank on the left-hand side. So we put in the statement balance, which was $2,050. That's the ending balance that you're putting in, not the beginning. Then you're going to add a deposit that you put in after the bank closed, then get recorded till November of $145. And next you have two checks that haven't been cashed that you wrote. And so you're going to add those two checks in. So you're going to add $350, and you're going to see that now your adjusted bank balance is $1,845. Next, we have the book balance, which is right out of the cash ledger. All right, you're going to open up the cash ledger. You're going to see what it was on October 31st, and that's the balance you're going to look at. You're going to put down 1405. Then you're going to add the note collected. You're going to add the interest you earned, and that's going to give you a subtotal of $18.98. Then you're going to subtract the check printing charge of $23 and the bounce check of $30, and that's going to give you $1,845. And guess what? They match. So you're in balance. I've got to let this little creature out. Get her to stop moaning. I'll be right back. Well, look like Max changed his mind. He doesn't want to go out now, which is what I have to put up with this dog. I'm going to stop here for a minute and see if any of you have any questions. Okay. I don't see anybody coming off mute, so I'll continue. Now we can see what the journal entries will be for all this activity that we just found when we reconciled. So on the notes receivable, where the bank collected a note for us, we're going to debit cash and we're going to credit notes receivable. Okay. For interest earned, we're going to debit cash and credit interest revenue. For the check printing, we're going to debit miscellaneous expense or whatever account we put it in. I would put it in bank fees, but it really makes no difference. It's going to be subtracted from income. And then we're going to credit cash, $23. Anything that the bank adds to us, it's going to be a debit to cash when they increase our cash in the account. It's treated like a deposit. Whenever they take money out of our account to pay for an expense, then like the printing charges and like the bounce check, then it's going to be a credit to cash. Okay. If you notice on the last one, the non-sufficient funds check, what do? Well, we credited cash, but guess what? We created accounts receivable account for this guy that bounces check by debiting accounts receivable $30, because now we're going to go after him for that money. And until he pays and makes good on it, we're going to carry it as accounts receivable. All right. First formula of the week is the day sales uncollected. Under this, we're going to take our accounts receivable and divide it by our net sales times 365. Obviously, this number, the lower the number, the better, because you don't want day sales collected to be huge. All right. You don't want it to be long. You don't want to be like the fish restaurant I told you about from the show called The Profit, where they were owed $250,000 and never bothered to get on the phone and find out where their money was. All right. And that's the end of the chapter. We're not going to worry about the appendix. Are there any last chance for questions? We're running out of time here, but I want to make sure if you have any questions, come off mute and I'll do my best to answer them for you. Okay, I don't see anybody coming off mute, so I guess you have perfect knowledge. You're going to turn around and get 100 on the quiz and get 100 on the homework this week, so I don't have to worry about that, right? The phrase that pays, the phrase you need to put in for the survey, if you are watching this video later or even attending tonight, is what I want you to do is say that you get 2 attempts on the quiz, which has been in place now since the beginning of the semester, and that if you don't do well the first time around, you should reach out to me so I can help give you the right answers to make that 100 next time around. All right. Now, what I tell my face-to-face class is, if you take advantage of this and I get stuck trying to explain it to you so you will get to the correct answer, there have been times I've just given you the answer for reaching out to me. All right. So I feel like an easy 100 is the homework, an easy 100 is the quiz, because you have multiple attempts. So take advantage of them, because some of you are going to get to the end of the semester and you'll be sitting there with like a 89.2 average, and you'll be stressing over whether or not I'm going to kick it up to an A or leave it at a B. So do yourself a favor, make it easy for me. Okay. As always, if you have any questions, feel free to reach out to me by email. I will get on the phone and talk to you if you're struggling trying to understand the information. But just know that I'm going to be asking, did you read the chapter? And know that I'm going to be asking, did you watch the videos at least once? Okay. All right. With that, have a good week. Good luck on the test if you haven't taken it yet. We have our Unit 2 test due tomorrow, so don't forget about that. And see you next week.